走进纽交所，直击华尔街。在本周的全球市场波动之中，美股市场也迎来了一定的震荡行情。目前，全球投资者正在仔细评估大型科技股的震荡情况、估值情况，以及美联储未来的降息路径。今天，我们邀请到 Cfra Research 全球首席投资官 Sam Stovall 与我们一起来解读本季财报季的情况。Hi Sam, thank you so much for joining us today.
My pleasure. Thanks for inviting me.
So how would you describe this earnings seasons, both in terms of results and market reaction?
I think it's been a very good reporting period. Q3 is expected now to be the 64th quarter out of the last 65 in which results have exceeded end of quarter estimates. Instead of growing by 7%, which was anticipated by S&P Capital IQ consensus estimates at the beginning of the quarter on September 30th, now earnings are expected to be up 12.5%. I think this strong earnings push helped make the market go higher in October and therefore resulted in that sixth consecutive month of price increases.
From your perspective, which sectors have outperformed and also which sectors have underperformed?
Well, 10 of 11 sectors actually saw upward improvements to their end of quarter estimates. Leadership was seen in the technology, communication services, and financial sectors, with the last two actually beating their estimates by a more than 2-to-1 margin. Industrials was the only disappointment in that their earnings now are likely to come in at about 2.6% versus the earlier estimate of 9.8%. And then finally, only consumer staples, energy, and real estate posted declines.
The Magnificent Seven now account for nearly 40% of the S&P 500 total market value. So does this level of concentration create vulnerability for the broader market if any single name stumbles?
I think so. Even though technology is on target to record a 26% year-on-year increase for the third quarter, up from the 20% expected at the beginning of the quarter, many of the Mag 7 groups saw increases that were twice as high, up to 53%. However, many of the companies within those groups trade at upper double-digit PE ratios and some even in triple-digit PE ratios. So as a result, I think disappointments would have a very large negative impact on the overall market.
Do you see a risk that big technology companies are approaching bubble territory?
Well, right now, the S&P 500 is trading at a 40% premium to its 20-year average PE, and technology stocks are trading at a 65% premium, but that's actually down from a near 75% premium just a couple of weeks ago. So while I think the debate is out as to whether it is truly a bubble, I think we're certainly getting stretched and we need to digest some of these gains and reset the dials.
Big tech dramatically increased capital spending on artificial intelligence. So what signals should investors watch to confirm that this spending will translate into real economic returns?
Well, I think what you have to do is wait for the quarterly results, hear the actual revenues and earnings, but at the same time, await the guidance that these companies are likely to provide. Yet at the same time, if you have companies that use AI that are showing an improvement in their operations or even reducing their headcount because AI is now satisfying the efforts of these employees, then that in and of itself could be an indication that AI profit is starting to improve.
Berkshire ended this quarter with a record of $358 billion in cash and equivalents. How do you interpret this large cash position?
Well, it sounds as if Warren Buffett is actually listening to his own indicator, the Buffett rule, which looks at the market capitalization for the S&P 500 compared with U.S. nominal GDP. Usually it set off a warning signal at about 100% and caused the market to slip into a near 50% bear market back in 2000 when it eclipsed 120%. Today, however, the S&P's market value is more than 190% of U.S. nominal GDP. So I think that is a concern to Warren. Even though I don't have a direct telephone line to him, I think the implication, therefore, is that many stocks out there are overvalued, and he's waiting for a pullback in prices to make them look much more attractively valued. I just mentioned that the S&P is trading at a steep premium to its average, technology even more so. But every single sector except energy is trading at a double-digit premium to its 20-year average forward PE. Only energy is trading at a discount.
So will you be able to provide a year-end estimate for both S&P and NASDAQ?
We are working on our year-end S&P target right now for our year-ahead outlook piece that will come out in the middle of November. We are remaining optimistic for the coming calendar year, but I do remind investors that we are in a midterm election year, and those are typically quite challenging. Since World War II, the average gain has only been 3.8%. And at the same time, the average drawdown or intra-year decline has been 18%, the highest of all 4 years in the presidential cycle. So I think it could be a good year, but certainly not a great year.
With the government shutdown delaying official economic data releases, investors are relying on private indicators like ADP employment and corporate layoff announcements. So which alternative indicators do you think are most useful for assessing labor market conditions right now?
Well, you're right that November 4th marked the 35th day of this government shutdown, tying the government shutdown in 2018 into 2019. As a result, we are not getting government data. And so investors have had to turn to private data. And in terms of employment, ADP has been the oldest supplier of private employment data. However, the Indeed website, the hiring website, also recently provided jobs data and indicated that job openings in October actually had slumped to the lowest level since February of 2021. So layoff announcements by IBM recently also have been dampening the impact of investor optimism.
You said you remain optimistic toward the end of two last months of 2025. So looking ahead, what key factors do you think will drive market performance over the next 2 months?
I think that we're going to need to see investors become more confident that the Fed will indeed cut interest rates another time, which we believe they will. We probably won't be hearing much more in terms of corporate profits, but if we can start to generate some whisper numbers as to what the Q4 results will likely be as they are reported in January of 2026, I think that could help. We are now in the favorable 6-month period of the market, so seasonality will be important. From October 31 through April 30th, on average, going back to World War II, the market has gained nearly 7% versus less than 2% for the May through October period. So seasonality is certainly on our side. And at the same time, if we can get some additional trade agreements, I think that will help to provide some support under this market.